Huge market value right now. Hoping to take down Amazon.com is Jet.com. Now it is up and running. The company has no profits and likely won't for years to come. But early private investors say this company could be worth as much as $3 billion, which would make it one of the highest valued technology startups ever. With more on his plans for internet retail domination, I am joined by Jet.com CEO Marc Lore. Ling Kent also joining the conversation. Marc, good to see you.
Yeah, thank you.
Thank you so much for joining us. So tell us first about Jet.com and why we would want to go to Jet.com over on Amazon.
Sure, it's a shopping club where you can save money on everything you ordinarily buy, everything from toothpaste to TVs, small size, large size. You can save about 10 to 15% below the lowest prices you'll find online on millions of products.
How do you differentiate yourself in this crowded space and with Amazon, so dominant?
We're really focused on innovating around price. So the proposition is very simple. You pay $50 a year for an annual membership, and you save hundreds of dollars. So it's very focused on saving people money and teaching them how to shop smarter.
As a consumer, it sounds to me like a Costco type of, or BJ's or Sam's Club type of idea. You pay the extra up front, but you're going to get the savings once you start shopping.
That's exactly right.
I got something right, Maria. See? You're getting
a lot of things
See, Mom, I got something right.
Don't hurt yourself patting yourself on the back.
It's okay.
The very big difference, though, from Costco is where the typical Costco might have like 3,000 to 5,000 products. We'll have millions of products for sale at Costco-type prices, and you don't have to buy the big bulk stuff. You can buy the small sizes, too.
But you, right now, and it was highlighted in the Wall Street Journal, when you don't have products available to you through your merchant partners, you have to go out to other retailers and buy those products for your customer. In one instance, the Journal bought 22 items and more than half or 12 were shipped from like Walmart and JCPenney and Nordstrom. That doesn't make economic sense for you. How long can that last?
Yeah, it doesn't make sense in the short term, but we're basically working backwards from a value proposition and a business model that we know is viable in the future. And, just like any startup, you have to sort of be scrappy early on. And
but how long can you How long can you go based on the funding that you have when you're losing money like that?
Yeah, we have to raise more money, no doubt. Mm-hmm. But if you look at the amount of money we need to raise and the value of the asset that we can create with that money, it's a order of magnitude sort of return for a big return for investors. So we feel really good about it.
You guys have raised $225 million, and the valuation, as we referred to earlier, about $3 billion. Do you think, though, looking at how much you've raised based on how little that has been accomplished so far, that maybe there's too much capital available? Are we in a bubble? Do you sense that when you were raising money, that it's easy to make money like this?
Yeah, no, I don't. I think the amount of money we raised is just commensurate with the amount of upside opportunity. So you can see even Amazon results today, right? I mean,
huge.
The enormous e-commerce market in the U.S., it's only $300 billion online today. It's going to $1.2 trillion over the next 10 years.
Wow.
So you have $900 billion coming online. There's a massive opportunity for any e-commerce player that sort of gets it right.
Do you think that we'll see lower numbers when it comes to brick and mortar as people transition to online? Where does that $900 billion
it's not
come
growing
from?
the overall pie. The overall retail market's not growing anywhere near the rate of commerce. It's just shifting from offline to online. I think we're sort of at an inflection point now where, it's still cheaper to buy your everyday essentials offline, going into brick and mortar stores. But over the next, 5 to 10 years, it's going to be cheaper to get your everyday essentials delivered to your door. Once that happens, I think you're going to see an explosion, because if you're buying your everyday stuff online and it's coming to your door, it's cheaper than going to the store. Just buy everything else.
You're not going to want to go to the store.
Exactly.
What can you tell us about the reception of customers right now? I mean, we're debating every day here how strong the economy really is. So are you actually seeing people spend money?
Yeah, I mean, we've only launched a few days now, but it's been amazing.
Is it a tough retail environment, I guess is what I'm asking you.
Today? I mean, we're not finding that, but it's a startup, so it's hard to say what the market's doing.
How far out, though, and it was back to my original question, how long before your company does not have to buy goods from other retailers? Like months?
Yeah.
How many years?
Yeah, months. I mean, you can see it already shrinking dramatically. Most of the sales, in fact, 80% of the sales today already come from either, Jet's direct warehouse or direct merchant partners. It's only 20%, and that's going to go to zero pretty quick.
What's your timing in terms of when you go public?
No plans to go public.
No plans right now?
No.
Come back soon, Mark. Yeah. Tell us about it.
You tell your investors that. They want a liquidity event. It's either getting sold or going public.
Mark, great to see you. Thank you so much. Appreciate your time. Marc Lore joining us. Joel and Ken, thank you so much as well. We're